loan. And I'm wondering if these things are even documented or they're taken out and not considered on the net balance sheet. I'm sure they're somewhere,
No,
right?
no, no. They treat a loan, a trial loan modification is in default, and a permanent loan modification is cured
Okay.
until it goes back in default. So that's how the banks are doing. So you cure the default with a loan modification, technically
Okay.
speaking.
So they're considering it
So there's
a
not
full
really
restructuring and rewrite. Okay.
now we know that pool of loan mods has a really high default rate. So they might put them in a different category, but but it's like being almost pregnant. You're either in default or you're not.
I agree. I agree. And I wonder how those numbers really jive out. Tina Hambleton, David, can you talk about the new tax implication for short sales in 2019? Are there?
There
Question
are
mark?
no, yeah, there's no new tax implications. The tax implications are exactly the same as they were for this year. There's been no modification. The questions that related to that is that if you do a short sale, you are going to get a 1099, but that event all by itself does not make it taxable. It's really only going to be taxable if the homeowner who's receiving the 1099 has assets that are greater than the loss. If the assets that they have at the time of the short sale are less than the amount of the loss, they would be considered insolvent. And through that insolvency, they fill out the appropriate form, which I don't know the name of it, the number, but you just Google an IRS insolvency form and it'll come up, and they fill that out, and it's not a taxable event.
Same as before, Form 982 of the IRS, Tina. You are
And
correct.
let me asterisk that by saying I am not a CPA and I'm not
Right.
giving accounting or legal advice.
Please always consult with your attorney, CPA, broker, mom, dad. This is my favorite line from my original webinar. I would do the Form 982, but of course, please consult with your CPA, attorney, mom, dad, whomever. Anybody that you feel is qualified to give you professional advice. Certainly don't take my word for it. Let's see. By the way, hi, everybody. Welcome to your webinar. Lee Honish, David Bartels. We are just 22 days, 22 hours away from our annual marketing summit. I am very strongly leaning on discussing at the event from a data standpoint. I'm starting to really feel the vibe about going after 30, 60, 90s and finding a new source of data before the banks get involved and basically screw up somebody who's going to default anyway. They're just prolonging this, David, and it's starting to irritate me.
I think there's some merit to tagging 90-day delinquents that are NOD.
Yeah, I do too. And I've just got to find a good data source for it. I think that the minute the bank gets involved to clear up their books and keep their numbers all, so many things wrong with what happened from the market collapse. So many things. We were talking about it before we started. And for the new people, I'm sorry. This is David Bartels, owner of Home Loan Advocates. He is your coach. He answers very smart questions. David, please get out your info, as always.
Okay. Well, David Bartels, Home Loan Advocates, and other related real estate companies. So Home Loan Advocates is basically a distressed property consulting firm where our primary source of income is short sale negotiations, where we figured out how to get the bank to pay us to do those short sale negotiations for you, which means if you're running into a difficult challenge and you need or want somebody to handle the heavy lifting that has to be done with a bank on a short sale transaction, we'd be a great resource for you to consider and get information from. So in those scenarios, there's a 72% chance that the bank will actually pay our fee, and it will cost you nothing to have us do it for you. And if you wanted to chat with me, you could do it at 805-413-8000, 805-413-8000, or email at david@homeloanadvocates.com. That's plural, advocates.com.
There you go. Donald Ross, what percentage of permanent loan mods go back into default? Good question.
Well, I know they in their net present value calculator, the banks use 40%. So, but that includes trial loan mods, by the way. So I don't know what the permanent loan mod numbers are, but I would say give or take 40%.
There you go. For anybody who wants to make sure that they sign up for the event, prereo.org, 22 days away, 22 hours away. It will be a phenomenal day of discussing how to get listings out of the pre-foreclosure market. Enough said about that. Go ahead and load up your questions. We'll be happy to discuss any and all of those. We had talked about this, I think, last year, David. You were thinking of going into the property management business with this report that just came out on Housing Wire, which is kind of all over in the last couple of days. Are you surprised, having sold off all of our REOs into all the trusts and turning them all into rentals? Are you surprised that the market with the pricing has turned into a rent desirable market? I guess that's the correct word. Are you surprised by it?
No, I mean, the reason that I started thinking about and dabbling in property management was because I wanted to create a lead funnel, basically, of rental properties. Because if you, just like we do on advocate marketing, where you are establishing a trusted relationship with somebody who has a high probability of doing a real estate transaction, not different than an expired or a FSBO or a divorce or a probate. For all those reasons, I wanted to be in the property management business, because at some point in the future, they're going to want to assess the value, and there's a rather high probability that they're going to do additional transactions, or they're, by adding additional rental property, which they're going to seek our advice on and assistance, or they are going to want to liquidate their property and roll it up into a 1031 exchange, which would be another buy-sell transaction. So my goal initially was not really to make a bunch of money doing property management, though that's certainly possible if you can get enough doors. My objective was simply to build trusted relationships with people who had a high probability of doing a transaction or two a year.
Tina Hambleton, I did that in 2007, and it did prove to be a great funnel, but can be painful, David.
Oh, for sure. No, it is painful, and you gotta have staying power, and you're gonna do a lot of work for a little money in the beginning, and it's a very labor-intensive business until you get enough doors to support a staff person that can handle it for you. So in the beginning, you've got to do it on your own because there's no money to pay anybody else to do it. But once you get over that hump, then it's much easier.
Go ahead and load up your questions. I'm going to keep playing hypothetical with David about the market, since we are clearly at a turning point in the real estate market. This has to be the summer of make or break. Like, they've either got to figure it out, or the rates have to be, I don't know what it is, but I figure this is the year that it's got to work itself out, or it's going to go in the wrong direction. So I'll keep playing hypothetical till questions pop up, David. Hypothetically, you are the czar of real estate back in 2007. You'll like this one. It's a good one. You were elected czar.
Okay. 2007.
2008. And somebody walks into you and says, all right, we're abolishing this REO thing. The president's going to sign this. It's been lobbied for. We're going to let Wall Street investment firms with this weird, wacky trust start to purchase and hold properties and they're going to get a clear mainline funnel. Would you have kept it in the hands of realtors? You got to remove yourself from being a realtor for this scenario. Would you have kept it in the hands of realtors, or would you have still done what we basically did, which is turn this into a rental economy?
Well, it turned into a rental. I'm going to answer that, I think. Well, first, I was not a realtor in 2007. I had just sold my company Selling Smarter to Doc Magic, and we still didn't recognize what was happening at that point. So it didn't become clear until the beginning of in the 2007, 2008 to us, when when all of our clients we were servicing the mortgage industry, and all of our clients started going out of business. So, so having said that, and attendance at our seminars went down dramatically because we were training loan officers. So what happened so the answer is I don't really know. See, the part that you didn't know that we didn't know was the massive size of it. No, it was
Right.
unprecedented. And so if it was a normal market in the beginning, that's what they did. They kind of relied on the individual realtors. And these guys that had these REO relationships with the banks just killed it, right?
Yep.
And everybody else stood outside watching. But what happened? The numbers rolled up so fast, and they couldn't process it out through the individual channels, that they started just packaging them in bulk, just like they did these the mortgages that were collapsing, the secondary market. And they basically created a secondary market for real estate inventory to sell them in bulk just to push it through the system. And that was aided by federal money. So it was the bailout money that allowed them to write that inventory down and then package it and resell it, so that they can tear it out. Otherwise, it would have been a slow, arduous process. The
Right.
thing that surprised me and you and probably lots of other people is that we kept thinking, because we kept hearing that there's going to be a lot of inventory coming on the market. The banks are going to release
Right.
inventory. They're holding all this inventory, and it never showed up. It still hasn't shown up.
It still hasn't
And
showed up.
the only difference is we stopped talking about it because these hedge funds started buying. But on the other hand, you can thank the hedge funds, because they, in Southern California at least, they really they're the ones that started this 2011, 2012 surge in home values, when, again, to our surprise, these guys were out accumulating money or accumulating houses at retail or above. They were just outbidding everybody for what was traditionally a distressed property that was sold at a discount to market. These guys were coming out and paying retail to get these houses, with what we thought was a strategy to hold for 3 to 5 years and then resell. And that hasn't happened either. So they turned it into rental market. And that's why the California Association of Realtors is saying that by 2025, not that long, California will be 50% rental. We'll have more rentals than or non-owner occupied is what they call it. And that was really that news a couple of years ago is what really is forcing me to face the demons of doing property management, even though it's I really don't have time to mess around with it. And I'm just gonna have to pay somebody $40,000 a year to do it for me, I think, just so I can get there, because it's got a long-term it's a long-term play, from my perspective. But yeah, so if I
Yeah.
were to do it, I would
You would have let the market
probably done it.
crash harder?
No, I don't.
I
It
mean,
was scary. I mean, it was scary. I don't know if I would have let the market crash harder. I'm not smart enough to know what to do. But I think that at the end of the day, there was a decision across the board, some deal making that was made to push this stuff through the system faster so we can get to the recovery. And even that took 3 to 5 years. And if you had not done that, I think that that it would have stagnated, and we would just be beginning our ascent that we started in 2011, when it became a very strong seller's market because there was no inventory. And
yeah.
now we're just now seeing inventory. And what you said earlier, I think, is right, that if we don't that last year we never saw the spring summer selling season. It never materialized. And the question I'm having now, and what we're waiting to see, are the buyers going to show up this year? There's going to be inventory. The question is whether or not there's going to be buyers. And if buyers don't come in to suck up all the inventory, then you're going to see the market decline further, maybe another 3 to 5%. But it's
Right.
not going to crash. It's just going to slide.
No, and for those of you wondering if there's I don't think there's an abrupt crash, but we know this because I've done it for this long, and David is a trend follower. the market is going to depreciate. It's an inevitable fact of the real estate market. It's an inevitable fact of the stock market.